Hey guys, how's it going? Bit of a sunset there, bit of a different time of the day for me. Welcome to episode number 3. Once again, shooting from the hip. Never any preparation, apart from sometimes some mental preparation. So I thought today, this series of first videos that I'm putting out, they're all sort of things I can speak about just off the top of my head to do with DIYing, more conversational things rather than showing anything in particular. Makes it easy for me to film, get my foot in the door of YouTube and see what sticks, you know. So today I'm going to talk a bit about investing. I had a mate who was looking into it the other day and started talking about it and realised quite a bit, you know, that I could tell a beginner. And I thought I'd jump in on a video and talk about it. I just have to be mindful of bike riders, because this is actually a little bike track here. I'm up here. I don't want one coming at me. That's why I'm sort of walking through the bush, coming at me while I'm concentrating on this. Anyway, so investing. Primarily today I'll talk about investing in the share market, and this is sort of applicable to Australian shares because I'm based in Australia. You're always going to get some additional taxes and fees if you trade in other markets, so it is really best to pick stocks from your market. And even though they're in your market, especially if you're trading some exchange traded funds, ETFs, which target a broader index. So an index is like a lot of different companies that target a certain index, say tech or the biggest 500 in the US, or finance, banking. You know, there's an ETF for almost everything. That tree just groaned, especially on hot new topics. So, you know, AI is a big one. That's a hot topic, and I bet you there's a million AI ETFs that have sprung up because of it. Anyway, that's a roundabout topic. So yeah, you can get into other markets through ETFs that are in your market, which helps you diversify your portfolio. So I was going to talk about risk and your appetite for risk when you're investing, because that's all it really comes down to, is your time horizon and your risk. So what is risky? Well, investing in things you don't know about is pretty risky. So say I know nothing about AI, I only heard about it in the last week. Would I invest in an ETF that had 10 AI stocks in it? So not a very broad ETF as far as ETFs are concerned. It's targeting 10 that ETF think are going to go up, and they have a fund managers as part of whoever runs that ETF. So there's BlackRock and many others, iShares, so on and so forth, that have plenty of ETFs out there. So you can get really broad ones which track indexes, less risk. You're spreading out the risk. If one company fails, out of, say, let's say we're talking about the S&P 500, biggest 500 companies in the US, I believe, or maybe it's one of the exchanges in the US. See, even I don't know everything. If one of those companies goes bust, you're barely going to notice much on the S&P 500. It's tracking bigger indexes, bigger market moves, and it's really the big banks, the big fund managers who are moving those markets. So you're just along for the ride, really, us mum and dad investors, and those fund managers are trying to shake our cash. So as soon as there's a news thing, they're gonna go nuts on it. I remember I was invested in lithium, and I have long-term views for lithium, where, you know, at the time, I don't know when it was, I always think about when my kids were born and think about the years around that. So yeah, maybe 2017, I was thinking, you know, EVs are coming online, home batteries, you know, people are wanting to get off fossil fuels. All of this is going to ramp up. So you know, if I looked 20 years into the future, I could only see lithium becoming a bigger and bigger thing for producing batteries. And yes, there are other battery chemistries, but I just saw it going up. So I invested, but then I think it was BlackRock brought out an article or something where they foresaw an oversupply of lithium, that there was too much lithium in the world, and that just started to send the price down for years, like a couple of years. It just kept going down, and I just kept buying. You know, I had made up my mind about what lithium was going to do, and I didn't care what other people were saying. And that's sort of the risk about knowing what you're investing in or not knowing. There's one of your risks. You got to kind of make up your opinion on the thing first, research it a bit, get a long-term view. Now that's the other thing about risk, is how long are you in the share market for? If you want money tomorrow, the share markets, you can do it. You can day trade. You're going to need to learn a lot and learn really quick, and even the pros don't get it right. Like, there's a lot of stats out there. Once you start doing your research, don't take my word for it, always do your own research. And none of this is advice, stuff people always say when they're talking about finance. Yeah, do your own research. I lost my train of thought on the do your own research thing. I might cut this here. Yeah, your time horizon is a big one. So if you're day trading, anything can happen. A news article, the bots in the big banks could be doing a buy sell. You know, these guys have meetings. Who knows what goes on in the finance world? I'm not part of it, but there's stuff going on. They're there to make money. They're making backdoor deals. They know stuff before we even know it, before it gets released to the market. Yeah, they're ahead of us, and what we can do is we can ride the wave. One thing we have is time. So if you're not going to ride it out for the time, you're increasing your risk. Time, if you've got a 10-year or more horizon on the share market, and you're going to invest, then it is highly likely, based on all the indices and lots of research, that you will make money, because share markets always go up. Also, they have up until now. Like, there's been huge crashes, but they've always, you know, gone up from there. I shouldn't say always. Probably there's cases out there where they don't. So a 10-year or more time horizon is good, and do it with cash that you don't need to pull out, because if like the lithium, it goes down. You don't want to be selling while you're down. You want to wait until the market realizes that that was a scare. Yes, there might have been an oversupply, but you know, that lasted a year or two, and then new gigafactories came online, more production, more demand, stronger emissions targets, all of this sort of stuff. This is just one example about my story in lithium. And then it comes back. So I was only able to wear that out because I didn't need to take out the money. Sure, you don't need to be in the stock for 10 years. You can, if you're up, what's the loss in selling? Like, if you need the cash, you can sell. I sold some of my lithium stuff because I was building my own house. I needed the money and I was up. You know, I'd rather have it in my house. Oh, this is a bit dubious section here with snakes and whatnot. Circle back a bit. Where I had the freedom to either leave it in or pull it out for, you know, a bit of extra cash. I ended up at that time selling a lot of my shares, or everything really, and putting them into my building company and my build, because that's where I needed the money and I was up. I didn't need to hold on to it. I'd rather have it in my own company. So that was one really important thing, is your time horizon. And yeah, just chuck in money that you do not need at all, almost like you're gambling. But know that if something goes down and you've got a firm belief that it shouldn't, then just stick to your guns, you know, and buy the dip. I would just suggest buying while everybody else goes crazy. You're the one who's just sticking to your guns and buying, and then while everybody's, you know, while it's going up and up and up and up, and everybody's not freaking out and loving it, that's when you should be selling. It's impossible to time the dips and the peaks, and you can get into technical analysis and all of that, but for your average guy who's got family, kids, everything, you're not going to be at the computer every day for an hour. That'd be your minimum. To do your technical analysis, figure out what's going on, and then make a call. Don't risk that. Don't even look at it. Do your buy. Next time you have your next allotment of money available, buy again. Maybe make more of an effort in your budget to buy more when things look cheap, when things are going down, and then sell when they're, you know, up. As of this 2025, Trump's just gotten in. Everything's pretty up at the top, so I'm not buying too much. I'm still holding. Last time Trump was in, it was pretty good for the share market. Anyway, we're getting away from that. Now, the other thing you need is a platform to trade on. And if you're just starting out and doing $500 trades, 1,000, even 10,000, you want to look at the fee to trade, because every trade you're already down money. If you're paying 20 bucks on a $500 trade, you're already down. You need to go up 1, 2, 3% before you even break even. So the bigger chunks you can buy, the better. And yeah, so look at the fees associated with buying and selling, what the minimum buy and sell is. There's some, you know, you can trade really cheaply, but your max trade is, you know, $1,000 or something. What was there? The Robinhood. I don't know what Robinhood's like right now, but 10 years ago when might not have been 10 years ago. You know, that was one of the ones where you traded penny stocks. You didn't have to spend much. It was cheap to do your trades. So that was a pretty good one. There's plenty out there. Do your research. Look at what they allow you to trade, how much you can, you know, trade with, and then go from there. Usually your bank, who you set up with anyway. So I'm with NAB. It's National Australia Bank in Australia. They have one called NAB Trade. Commonwealth Bank has one called ComSec. I just went with the one with my bank because they had a fairly good rate per trade, and you know, all the tools are in there. They all have similar tools, and then they have like a really fast version as well with FSS and all of that if you want to upgrade and do more of the day trading thing. So yeah, I guess get into it, start putting some money in, see where it goes, because you're just going to learn from experience what of your trades do well, and usually the ones that do better, at least in my opinion. I did some riskier ones, some more penny stocks, you know, like satellite stuff, wine companies, all sorts. You know, mates always tell you something, or you hear about something, you go, oh, give it a go, you know, it could explode, you know, they'll strike oil and we'll get 100x our money. Also, all your money could be gone quite easily, because there's very little underlying assets in the company. I guess knowing a bit about business, directors, you know, profit and loss statements, so you can look at their financials and see how they're tracking, how many shares they're issuing, who owns the shares. You know, is the director or the CEO buying shares in the company? Does he believe in the company, or is he selling shares in the company? You know, often they give, you know, out shares to the CEO. They do like at their annual general meeting, they'll go, this year let's have a vote, how many shares should the boss of the company get? And then he usually has terms on it. You know, he can only sell in 5 years, and then after those 5 years, is he gonna, you know, hold on to them, or is he selling them? That sometimes gives you a bit of an indication of what's going on with the company, but that's pretty far-fetched, because they do lots of things. You can't always read that, so it's really hard getting through the data. So I'd stick with your beliefs, think about things you're interested in, because it'll be easier doing the research, way easier doing the research if you're interested in it, or it's something you want to be interested in. Like, I don't know much about AI, I want to know more about AI. Maybe researching some companies and what they're doing with AI, and researching some AI tools will teach me more about AI, and I'll get to know the pool of AI companies, and then I can invest, you know. So whether, you know, the biggest ones at the moment, Google is publicly listed, Facebook is publicly listed, Nvidia publicly listed. But then you got to think, okay, if I want access to them, do I trade them directly through the US? Do I look at homegrown AI shares? And this is just one thing because it's hot topics in 2025. And the homegrown ones are going to be more risky. They're not massive companies like Google and Facebook that have big moats, you know, and they're going to flick up and down a lot less. You're going to be a lot safer with them just because of how big those companies are. Or, so, you know, there's a little Australian company, say I saw one the other day that looks at creating synthesized data to train AI on. Now, AI is a data hungry thing. If you want to train your own AI, you need to give it heaps of data. Like if you want to create an agent of yourself, the best thing you can do is like record everything about yourself, every conversation, get it down onto text, every video, so on and so forth, and that will, then you can put it all into an AI and train it on you, and then you'll have a bot on yourself. So, and then being able to synthesize that data with other AIs to then train AIs becomes really interesting, and there's companies that do that. Anyway, off topic again. So yeah, and those are sort of the research rabbit warrens that you go down to figure out what to invest in. And then you've got to have a long-term picture. Where do you think lithium or AI, or these are just things that I'm interested in, but whatever you're interested in, whether it's mining, you know, housing, property, all of those sorts of things, you can invest in it. Shops, shopping, consumer, tech, anything, yeah. Have a long-term outlook. Like if you're in consumer, are people going to spend more on booze to drown their sorrows as the world gets into global warming? You know, you could have that, and you could go, yeah, I'm going to, sort of like placing a bet, I'm going to bet that this will happen for sure. Alcohol consumption is only going to go up. Production costs are also, you know, there's going to be more scarcity as farming becomes more difficult. It's going to be harder to make alcohol with more demand and harder to satisfy supply. The share prices are just going to go up. So I'm going to invest in this brewing company, so on and so forth. But having that long-term outlook to weather the little storms, because there's things that can affect your share, your stock, that aren't even related to it. Global financial crisis. Many companies went bust. They had great business and everything went downhill. COVID as well. You could have had a great, but suddenly you had to do all the work from home, and you only have a factory, and your factory can't output anymore, and you've got overheads of rent and insurances and all of that you're paying out. And if you don't have a huge cash position in the company, a good balance sheet, then you can quickly go bust, regardless of how good your product was or any of that. So you want to be able to weather those little storms when other market factors send you down, so that you can buy more and keep making money. Anyway, that's a long video. Rambled on a bit long, but maybe long videos works. Who knows? Maybe you guys like that sort of thing. So yeah, I'll see you on the next one. Cheers.